want to be clear. I'm confident the Federal Reserve will act to achieve their dual goals of full employment at stable prices.
In 2022, we still are living within the pandemic, so we have work to do as we move forward.
I'm certainly confident that we are on a path towards transitioning this thing from pandemic to endemic.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. High stakes U.S.-Russia talks kick off in Geneva. The White House considers harsher curbs on Moscow. Treasury yields rise across the curve. Investors move forward Fed rate hike bets. Focus turns to U.S. inflation data on Wednesday. And from flipping burgers to the world's biggest crypto fortune, this hour we delve into the story of the Binance chief executive and founder, CZ. Now, the U.S. unemployment rate fell below 4% in December. That's adding to evidence of a tightening labor market there and to the growing expectation of sooner than telegraphed liftoff in the Fed's key interest rate. The U.S. President Joe Biden and the Labor Secretary Marty Walsh have full confidence in the central bank.
I want to be clear. I'm confident the Federal Reserve will act to achieve their dual goals of full employment at stable prices and make sure the price increases do not become entrenched over a long term with the independence that they need.
We're seeing lots of positive signs. We know in 2022 we still are living within the pandemic, so we have work to do as we move forward. You mentioned inflation. The president is focused on bringing inflation down. The president's economic policies continue to work. We're going to continue to move forward here in 2022 to make sure we get Americans back to work.
So this is what the markets are doing right now. We're seeing a bit of repricing, certainly yields actually at a pandemic high, not only in treasuries, but we're looking at fixed income across the world. And that's repricing a bit of the equities, but really not as much as we were talking about. My piece of the day is without a doubt John Authers once again saying that, of course, last week ended with the 10-year treasury yield, the single most important benchmark in world finance, at a pandemic era high. But this opens up, he says, for the upteenth time, a familiar narrative is if bond yields have been unnaturally low for years, suddenly climb higher, what does it mean for overvalued stocks? So if we look at the map of Europe to have a look at where exactly we're seeing the biggest gains or the biggest falls, again, markets at the moment trading sideways. The big one is CPI on Wednesday, which brings us nicely to my chart of the day, which goes exactly to what John Authers is trying to put up in his piece, which he argues that on several occasions, the mere possibility that bond yields are about to come unstuck has shifted markets profoundly. So we're looking at the U.S. 10-year yield when it touches 2%, and of course the correlation with equities. There's no other story than that. This year we're joined by Henrik Johnson, co-head of capital markets at Deutsche Bank, and here with me in the studio is also Christine Aquino from our markets desk. So thank you both for joining us. Christine, first of all, the Treasury yield, the U.S. 10-year, 2-year, I mean, full in focus, and it hasn't really repriced equities, and the million, trillion, gazillion dollar question is, when does it?
Absolutely, Francine. And in fact, you and I will have a million, trillion, gazillion dollars if we're able to answer it. But that still remains the big question. And I think it is going to be the key theme this year, especially as we're starting to see some narratives around equities starting to really cast doubt over the valuations that have skyrocketed in recent years, right? We've been talking about the potential for the buy dip sort of strategy starting to show some cracks. And of course, the tech sector valuations really coming into question at this point in time. And then, of course, the argument that Europe as a value-heavy sort of region may finally get that outperformance over the U.S. that strategists have long been flagging. And so these are kind of the broad themes, I think, that are going to be really going to be in focus in equity markets this year.
And Henrik, one of the things that certainly Christine and I were talking also about last week is the fact that the correlation between European equities and treasuries is even a little bit stronger than what we're seeing with U.S. equities. So what does it mean for what you're seeing for 2022?
Well, I think, as you've said, this is going to be a very exciting year in terms of the markets. And, there's going to be more volatility, and everyone's going to have to be a bit more nimble as they navigate them. So I do think one thing that's very important to answer your question about, a sudden sell-off. Let's not forget, central banks still have a lot of tools to manage the markets. So, while there has been some accidents during the course of 2021, and undoubtedly there will be accidents again this year as investors sort of stress about particular central bank actions. Don't forget, the central banks still have huge balance sheets and ability to move the markets to the places that they want to. So I think the possibility of a very, very bad sell-off, during the year is not going to be related necessarily to bond sell-off, but more likely to come from geopolitical risks.
That's really interesting, Christine. This is one of the themes that we were also trying to follow. Let's go straight to my morning must-read, though, which is on inflation. And it kind of, this is a Bloomberg economics piece looking at the twos and throws of what inflation data tells us. I don't know if we have a morning must-read. If we do, it'd be a great time to bring it up to show everyone what Bloomberg economics has been looking at. And they basically look at, the data from the labor market and max employment and what that means with inflation. So Bloomberg economics says with the unemployment rate dropping below the median FOMC estimate for the long neutral rate and wages growing risky, this jobs report will likely alleviate any lingering doubts on the part of more dovish FOMC members. And it's amazing. Republican economists, Democrat economists, and even Goldman Sachs now says the Fed is behind the curve when it comes to dealing with inflation, Christine.
Absolutely, Francine. And you can really tell as well from the reaction from the jobs report last Friday, right? If you had such a big headline miss as we saw last week, it would have caused a lot of concern in any other time. But I think the focus was really on those average hourly earnings figures that were higher than expected. And we saw some upward revisions as well from the previous print. And that really tells you where the focus is right now. It's all about inflation. And that really is something that everyone, as you say, whether it's the Fed, whether it's politicians, left or right, doesn't matter. That's what's really concerning most market participants and watchers right now.
Yeah, and Henrik, one of the things that really, plays to what Deutsche Bank has been doing, and I know what you've been monitoring, is a great chart looking at some of the sovereign debt issuance from Europe. And the question that, also Valerie, our queen of charts, was briefing us about is, will that destabilize yields in the absence of QE?
Well, that's a very good question. So far in the beginning of the year, we've actually seen a continuation of the heavy SSA issuance. And as you say, central banks have played a big role in buying that issuance. But I think we'll also see a little bit of a normalization of sovereign issuance throughout 2022. The pandemic programs are starting to tail off, and tax receipts, obviously buoyed by inflation and economic growth, are actually quite healthy. So hopefully the supply-demand imbalance doesn't go out of kilter. I think talking about inflation, there's three big megatrends going on right now, which I think will drive markets to a large extent. One is ESG and the need to adapt to a sort of fossil fuel-free economy over time. Second, deglobalization, and thirdly, digitalization. And all of those three things are going to drive markets and also corporate finance activity. But if you notice, the first two of those are also inflationary. They'll require spending on behalf of consumers and corporates. So I think keeping an eye on those inflation numbers is going to be very important for investors in the early part of this year.
Do you think, Henrik, that we're actually mispricing inflation expectations in Europe because we could be importing inflation, but also some of the supply chain crunch because of what's happening in China and also the U.S.?
I think inflation definitely is here to stay. I don't think that Europe is going to see the same high levels as the U.S. because there's more slack in the labor market here, and there's less consumption. European consumers are probably saving a bit more than U.S. investor or U.S. consumers have. So I think European valuations that we talked about earlier are actually due to rise. So I agree with that rotation into European equities from the U.S. as some of the value plays in Europe, and especially also here in the U.K. Get benefit from a relative perspective from that global rebalancing.
All right, thank you so much, both of you, for joining us on a market conversation. Christina Kino and Henrik Johnson, of course, co-head of capital markets at Deutsche Bank, stays with us, and we'll talk a lot more about some of the issuances that we've seen. Now, what's really captured our imagination, got everyone talking at dinner parties or virtual dinner parties over the weekend, is what's happening in Australia with Mr. Djokovic. Live pictures there of the Serbian tennis star Novak Djokovic following his win in the Australian court. The ruling has led to the cancellation of his visa and said the player should be released from a quarantine hotel in Melbourne. Of course, there's still another appeal that could happen, so it's not completely a done deal yet, but we'll be following this very closely. Coming up, bond issuance frenzy. European banks storm the new issues market as they brace for a messy year. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, European banks are piling into primary markets in a bid to raise cash before borrowing conditions turn more volatile. Even by the busy standards of early January, borrowers have been unusually active, while supply in the first week of 2022 was almost 50% higher than the same period in 2021. That's according to data compiled by Bloomberg. Well, let's get back to Henrik Johnson, co-head of capital markets at Deutsche Bank. Henrik, we're talking a little bit about some of the issuance that we saw. I think DB was also duration manager on that 30-year syndication in Italy last Thursday. Are we going to see more of those types of transactions coming to markets?
So last week was all about SSAs, as typically, early on, the SSA names tend to hit the markets. This week, actually, it may well be the busiest primary investment grade week for 6 months in Europe. We have a massive pipeline, and so do our competitors. And as you say, that's a lot of issuers deciding to hit the market early in the year and de-risk some of the trades. I think one thing that was very interesting last week was that despite the higher issuance, the average duration was down quite a bit in terms of what was achieved relative to previous weeks. So, in sort of your average week in 2021 had a roughly 8-year average duration. Last week was just 5. And so what you're seeing is an investor preference for shorter duration because, they obviously also don't want to own a lot of long-dated issuance in a rising rate environment.
So, Henrik, how difficult is it actually to break 2022, given some of also the political stance? I'm thinking about Italy and the fact that we could see a new prime minister, which would really shake confidence in the markets, or the French election, or is it just really what happens to Treasuries and the Fed that will dictate market? So I think what you're going to see is a lot of demand for issuance early on the year, basically to get ahead of some of the geopolitical risks. I think the rates are obviously going to be important, but don't forget, higher rates also mean higher coupons. So, that's attractive to a lot of investors. So even though issuers are paying more as rates, rise up, one, that's hedgeable, and two, hopefully, especially corporates and banks are seeing the benefit of an inflationary environment. So it's not a disaster that people pay a bit more for their debt. I think what investors are worried about is sudden sell-offs caused by geopolitical risks. Obviously, you have the elections, but I think the one that most people would worry about the most is in the eastern part of Europe, around the Ukraine and Russia. So what could that spark a sell-off of? I mean, again, it's unclear, and it's almost like game theory because you don't exactly know what Russia does or what kind of sanctions allies have. But what part of the market would see a sharp sell-off, first?
I think the correlation between asset classes is very high right now. So because of where valuations are across the board. So I don't think it's necessarily anything specific. I think what could cause the sell-off is, the fact that we potentially are entering into an armed conflict, in Europe, and that will cause even more deglobalization, sanctions, and so on. So I think that will give markets a knock. Now, having said that, I talked earlier in the program about the role of the central banks, and they still have a lot of firepower. So I think any sell-off, if it were to happen, would actually be relatively temporary. And the other point is that you may see some cracks in the buy on dip, but there is still huge amounts of capital out there, both in private equity funds and credit funds, Consumers are generally in Europe still relatively wealthy. So, I think that capital will actually limit the ability of the market to really sell off.
Henrik, give me a sense of how much money applies into ESG. I know there's concerns about greenwashing, and in terms of how much some of these investments, including ESG ETFs, performed compared to 2019 and 2020. It was a little bit disappointing in 2021.
So ESG in Europe was up 100% in terms of issuance year over year last year. APAC slightly more, Europe slightly less. We think that that's just going to continue. So ESG issuance, broadly defined, could hit $1 trillion globally in 2022, and we're seeing that already with the issuance that's happening early this year, because the green issuance is crowding out all other issuance as investors want to keep doing it, and that goes to the sort of the mega trend, that we're seeing, which is everybody needs to adapt their business to the focus on climate change. And I'm not saying this for ideological reasons. It's just the reality that capital is only going to flow to entities that are able to articulate an ESG case. And also, I should say, a digitalization case, right, where they're able to adapt to what's going on in the economy in terms of tech revolution of how consumers are behaving. And so, fortunately, I think ESG is going to issuance. And clearly, an important thing to happen this year is going to be standard setting.
All right, Henrik, thank you so much. Henrik Johnson there, co-head of capital markets at Deutsche Bank, joining us for a robust conversation on markets, inflation, and of course, issuance. Now, let's also look at some live pictures of the Serbian tennis star Novak Djokovic following his win in an Australian court. Now, the ruling has led to the cancellation of his visa. It said the player should be released from a quarantine hotel in Melbourne. Just a caveat with that, the immigration minister could actually still intervene. I think the federal court did order the government to pay the costs incurred by the tennis star and release him immediately. Now let's go straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK's Foreign Secretary says she's prepared to override parts of the post-Brexit agreement on Northern Ireland if EU talks fail. Liz Truss laid out her position in the Sunday Telegraph ahead of a key meeting with her EU counterpart on Thursday, describing the UK position as a pragmatic compromise. Truss warned she's willing to trigger Article 16 if needed. Now, a senior minister says the UK is on a path towards transitioning from pandemic to endemic. Education Secretary Nadhim Zahawi also backed moves to cut the COVID self-isolation period from 7 to 5 days as schools and hospitals continue to battle high levels of staff shortages.
We know with COVID, there are always variants. We keep a close eye on it. I'm certainly confident that we are on a path towards transitioning this thing from pandemic to endemic, but you've got to make contingency plans.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. I can't wait to know what you think about Novak Djokovic. I mean, we were looking at reports saying the judge was agitated by the issue of why the Australian government did not accept medical exemption. Now, coming up, the U.S. and its allies consider slapping export controls on Russia as tensions escalate over Ukraine. We have that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Biden administration may slap export controls on Russia if it seizes more of Ukraine. Sources say the White House is discussing with its allies potential restrictions on sensitive technology and electronics. Now, for more, we're joined by Bloomberg's Maria Tadeo. Maria, it's a very, very big week in terms of security for the world, Russia, Europe, of course, Ukraine and Kazakhstan. So what exactly are we expecting? Could we see a rift between Europe and the U.S. because Europe doesn't want to go too hard on Russia?
Well, you know, Francine, both have said that there will be immediate consequences on Russia if there was to be an invasion of Ukraine. The European Union in December, I'm sure you remember this, signed on to the language the United States has been pushing for weeks now. The consequences would be huge, they would be massive, and they would be immediate. Of course, we know that this package could potentially entail shutting Russia off the SWIFT payments. We could also see export controls. And in the most extreme scenario, then Russia could operate under conditions that right now we see in countries like Syria and Iran. So this is major isolation from the international sphere. When it comes to the European Union, however, the problem is different here. You know, they say that in many ways, Russia is a country that's located in Europe. We have to deal with Vladimir Putin. We need to keep that diplomacy going. And also, this is a time of the year, Francine, when the European Union, and not just the EU, but Europe as a whole, is the most vulnerable to Russia because of the gas supply and the winter months.
Yeah, it's going to be a tough negotiations, tough, intense talks. Our Bloomberg Maria today for us in Brussels. Coming up, we'll have more on the U.S.-Russia tensions over Ukraine with Tina Fordham. This is Bloomberg. High stakes U.S.-Russia talks kick off in Geneva. The White House considers harsher curbs on Moscow. Treasury yields rise across the curve. Investors move forward Fed rate hike bets. Focus turns to U.S. inflation data on Wednesday. And from flipping burgers to the world's biggest crypto fortune, this hour we delve into the story of the Binance chief executive and founder, CZ. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So first of all, the data check, because there's quite a lot going on in the markets, and that will continue for the next couple of weeks, months, and possible quarters. This is as we're seeing a repricing when it comes to yields, not a huge repricing, given the Fed expectations that we're seeing out there on the markets. But I bring everyone attention to John Author's piece saying, look, last week ended with the 10-year Treasury yield, the single most important benchmark in the world, finance at a pandemic era high. In 1 week, they surged by 27 basis points. And now what we need to try and understand is that the possibility that these bond yields are about to come unstuck shifted markets profoundly already, and they continue to do so, possibly for equities. European stocks, for the moment, unchanged at 486. Now, let's turn to the story also on geopolitics and U.S.-Russia tensions over Ukraine and get some analysis on the geopolitics. Now, we're joined by Tina Fordham, partner and head of global political strategy at Avonhurst. Tina, thank you so much for going on. Let's remind everyone, we have a great wall looking exactly what some of the negotiations or some of the talks are going on this week. They're meeting in Brussels, they're meeting in Geneva. This is representatives from NATO countries, also representatives from the U.S. and European, of course, leaders. What is the biggest concern that you have on Russia, Ukraine, or Russia, Kazakhstan?
Well, these talks were planned, of course, before the civil unrest in Kazakhstan, and they are taking place amidst a security crackdown in Kazakhstan, the first time that collective security treaty organization troops have been sent to keep the peace in a former Soviet republic, and as we have 100,000 Russian troops massed on the Ukrainian border. So for Europe, for the US, the paramount concern is about taking the heat out of the situation in Ukraine, about imposing costs via these promised sanctions, and making it more expensive, basically, for Russia to consider another Ukrainian invasion.
So how much more or how many more sanctions could we see against Russia this year? And how much will they bite Russia and the president?
Well, so far, Russia hasn't, Russia will tell us, Putin will tell us that the sanctions haven't hurt Russia very much. They are problematic. They have, the purpose of sanctions is to impose costs rather than to change behavior. And that's quite important. Biden has made clear that he wants to be tougher on Russia than he perceived even his old boss, President Obama, to be. But we're already seeing the U.S. starting to pull back somewhat on this position. For markets, for investors, probably the most concerning would be sanctions taking Russia out of the SWIFT system and others on the banking sector. But I don't think we'll see talk about that at this stage. I mean, they haven't threatened recently for the first time seriously in some time. But at the same time, Russia has also built some parallel systems. So there are questions about whether even that would be as damaging to Russia as it would have been when first talked about 6 years ago.
So, Tina, what are you expecting actually from Russia to do? We've seen, Russia coming to the help of Kazakhstan. They did so in the last 2 years, of course, with Belarus and the president there. Do they feel emboldened, and could they actually foray further into Ukraine?
I think that the costs for doing so have now increased significantly, but then Russia is now caught in the situation of having troops mobilized and not wanting to look like it's kowtowing to Western European or NATO demands. So what Russia does next will be the subject of much speculation. However, I am advising our clients that an invasion of Ukraine, an imminent invasion of Ukraine, is now less likely. At the same time, I'm also emphasizing that these are not binary options, invasion or no invasion. There's also a pretty successful effort on the part of Russia to undermine Ukraine's stability and integrity as a state, and a soft annexation is another consequence of mobilizing these troops.
So what are the linkages between, of course, what we're seeing in Eastern Europe and China-Taiwan? Is China looking at how the U.S. reacts?
China is watching very carefully, and I think an underappreciated diplomatic point of the last several months, at least from markets' perspective, is how, although we couldn't say Russia and China are acting in concert, they're certainly coordinating more explicitly than they used to. For China, any global incidence of impact on territorial sovereignty, a challenge to an authoritarian regime hits very close to home, and they will be looking to see just how high the costs are, the punishment is from what we used to call the international community for doing this. I think the point about wider challenges to authoritarian regimes will be of great concern, because in Kazakhstan, we had a relatively prosperous country, stable for a long time, and then the cracks appear.
Tina, do we know do we understand actually the reason why Russia has been so involved in Kazakhstan? Do they feel like if something happens in Kazakhstan, then it hurts and undermines their authority, or is it because of uranium?
Well, I mean, I would argue that the commercial and the national security interests tend to be very, very much interlinked. So there's uranium, and Kazakhstan is a client state of Russia, pure and simple. I mean, the former Soviet states, the Baltics, which joined the European Union, have obviously gone that direction. Russia's made a huge effort to maintain links through various post-Soviet organizations with other states. And remember that the 2014 invasion of Ukraine happened after the Orange Revolution, where we had a Russian-friendly leader in Ukraine who was deposed by popular unrest. Putin fears these so-called colored revolutions, orange revolutions, and others, almost as much as he fears NATO expansion. And he now finds himself in a difficult situation where even Finland, which had said it wasn't planning to join NATO, is saying, don't tell us that, that we can't join. This is our right. So there's a chance that this backfires for Putin, but I would argue that that could be a dangerous thing.
All right, Tina, thanks so much for all of the insight. Tina Fordham, their partner, head of global political strategy at Avonhurst, joining us this morning. Now, we're also looking at some live pictures of the Serbian tennis star Novak Djokovic following his win in an Australian court. The ruling has led to the cancellation of his visa and said the player should be released from a quarantine hotel in Melbourne. Now, this is what we know so far. First of all, the judge was agitated by the issue of why the Australian government did not accept medical exemption, but the immigration minister could still intervene. So it's not clear whether this court order saying the government will pay the tennis star's costs and release him immediately will actually be followed through. Coming up, from burger flipping to Binance chief executive and founder, we delve into the story of how the world's biggest crypto fortune came to be. That's our big take next. This is Bloomberg.
I think Hong Kong has so many advantages. It's there to lose. It continues to be one of the largest recipients of IPOs. It has a framework of governance and law. People can comment as to whether it's as good as it was, but it's still better than most other places in Asia. The ease of doing business is great, and there's a tradition around economic management and fiduciary responsibilities that is incredibly strong. So I think Hong Kong will continue to be successful. I think it's important for Hong Kong. I think it's important for China, in the broadest sense of which Hong Kong is clearly a very important part. So, I think Hong Kong will retain its position as one of the leading financial hubs in the world.
Of course, the relationship with China is vital as a gateway to China in some regards as well. But, with regulatory crackdowns, et cetera, and various headwinds the Chinese economy has been facing, not least, of course, the pandemic too, which is, of course, rearing its ugly head again. Do you find parts of China now uninvestable, given what I just said? And if so, there must be long-term plays elsewhere that you look at, given dual circulation and also common prosperity, as two dictums being laid out.
I mean, there are parts of every country that are difficult to invest in. So I wouldn't single out China. I mean, the holy grail in many ways for all investors is, where is the technology going to come from that will enable us to transition to the kind of world that we want to live in, or more importantly, we want to leave to our grandchildren, our children. That science base there's a huge technological science base in the United States, in the UK, in the rest of Europe, and in China. If China comes up with the holy grail of how you decarbonize steel or cement or so on and so forth, the rest of the world is not going to say, no, we don't want it because it was invented with you. So, China has probably one of the most compelling cases in terms of how do you continue to have a manufacturing industry in a world that is increasingly demanding of lower impact on environmental issues. So, we're in a technological world now. Where that technology is invented is irrelevant from an investment point of view. The world needs it. And, everyone who comments on the climate change challenge basically is clear that with the technology that exists today, we won't meet the 1.5 degrees. We need new technology.
Aberdeen Chair Douglas Flint there speaking to Bloomberg's Rishad Salamat at the 2022 Asian Financial Forum. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Reddit is pursuing an IPO as soon as March. Sources say the online social community is working with Morgan Stanley and Goldman Sachs and may be valued at as much as $15 billion in a public offering. Fidelity Management led a funding round valuing Reddit at $10 billion in 2021. Now, Chinese tutoring giant New Oriental Education slashed 60,000 jobs last year. New Oriental says sales plunged by 80% following Beijing's crackdown on the edtech sector in July. The company spent more than $3 billion on staff severance packages, tuition refunds and other expenses. And India's biggest budget airline is planning to scale back its operations as COVID outbreaks hit demand. Indigo says it will reduce its operations by about 20% and will waive the fee it charges customers for changing flights. Several Indian cities have imposed movement curbs, with just under 160,000 new COVID cases reported nationally in the most recent 24-hour period. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, Zhang Pao has gone from being a burger flipper at McDonald's to founding Binance, now the world's largest cryptocurrency exchange. In the meantime, he was also a Bloomberg employee in between. Now, Zhao, or CZ, as he's more commonly known among crypto enthusiasts, is now worth at least $100 billion. That's according to a Bloomberg Billionaires index. Now, when he sat down with our editor-at-large, Eric Schatzker, back in November in Singapore, Zhao said he's not motivated by wealth.
I don't really care about wealth, money, and also rankings, etc. I also I believe it was a Forbes interview just a couple of days ago. I said I will commit to donate 99% of my wealth away.
Well, the Binance chief executive's meteoric rise is the subject of today's Big Take on Bloomberg. And to discuss it in more detail, we're joined by Bloomberg cross-asset market editor Joanna Ossinger. Joanna, he's also made himself very available many times for this program. He's extremely charismatic, actually usually answers questions also straight to the point. How did CZ make all of that money?
Hi, Francine. It is a pretty interesting story. I mean, Binance has just risen so quickly. It was founded only a few years ago, and now look at this. The CEO is worth about $100 billion. And that isn't even including his personal crypto holdings, which are probably fairly substantial. But, Binance came at the right time. Other crypto exchanges were running into difficulty. They had a pretty good formula. They got people on board who liked the way they operated, liked how easy it was to get in. And of course, there wasn't a lot of regulation at the time. Countries weren't focused on crypto so much because it was still such an emerging technology. Now it's a lot bigger. Countries are more interested in what they're doing, and they've had to do a separate affiliate for the US. They've had issues with the UK, with Singapore, with Thailand, Malaysia, a lot of different countries. But they're still far and away the biggest crypto exchange. And a lot of that is CZ and his drive and his efforts to make this work.
Joanna, we're also looking at live pictures unrelated to cryptocurrencies, although we're seeing quite a lot of stars get into the crypto space. But this has nothing to do with that. The Australian minister is considering cancelling Djokovic's visa after the court actually gave him a ruling in favour. So we understand from the federal court order that the government now needs to pay the tennis star's costs and release him immediately. I think we're looking at live pictures of supporters of the tennis star, and maybe, just maybe, the star is in that car, which is why we're seeing quite a lot of commotion in Melbourne. Going back to cryptocurrencies and what we're seeing overall with Binance, how much bigger, how did they, Joanna, actually take over some of their rivals? I know it's difficult to start a platform to exchange crypto, but what sets Binance apart? It's been quite difficult in terms of regulation, also to find a home for it. I know now CZ is looking, of course, at the Middle East for the base because they have been very favorable to his company.
Right, and Binance has gone to different jurisdictions for different things when it sees that as a convenient thing. So over time, they've had affiliations with Malta, with the Cayman Islands. A lot of this was started in China, for instance, before there was the big crackdown there. CZ has been living for the past couple years in Singapore. So there is a lot going on globally. But, they came up when, say, BitMEX was starting to have trouble with regulators. And there are a lot of people who like it. I mean, when jurisdictions cut off Binance from consumers, there are a lot of complaints because people feel that it's pretty easy to use. They use their native Binance coin for a lot of things that makes the interactions pretty simple. And of course, Binance coin is now the 4th biggest cryptocurrency. It has been as high as 3rd. So there's just a lot of stuff that has worked well for them in their formula. But, again, they are running into, they're kind of the tall poppy in a lot of cases, and regulators are paying a lot of attention to them right now.
They certainly are. Thank you so much. Our Bloomberg cross-asset markets editor and, of course, crypto expert Joanna Ossinger in Singapore. Now, remember, you can read the Big Take in full on our Bloomberg.com or on NI Big Take on the terminal. Coming up, 4 rate hikes in 2022. That's the call from Goldman Sachs, and we'll discuss what all of that means for the markets with our Marcus Ashworth. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the focus firmly on the markets, on inflation, that data out of the U.S. on Wednesday. And then in that, it's going to be a huge week for diplomacy, especially to see what we do with Russia if the U.S. and Europe actually puts extra sanctions on Russia. Now, Monday kicks off this crucial week to de-escalate the situation on Ukraine's border. This is Brussels, and we're seeing, of course, Mr. Stoltenberg of NATO with delegations from Ukraine. Now, what we will see over the next couple of days is anyone's guess. There's also parallel talks on Kazakhstan going on in Geneva. Let's actually have a listen of what's happening in Brussels.
The time has come, and as a part of deterrence NATO policy, to provide to Ukraine membership action plan. Thank you.
What we have stated very clearly is, first of all, that we continue to provide support to Ukraine. Political support for Ukraine's territorial integrity, sovereignty, but also practical support with our comprehensive assistance package, with different trust funds, with different activities conducted by the NATO.
So we'll have plenty more, of course, on this diplomacy. Big week for diplomacy, big week for Russia, EU, and, of course, Kazakhstan and the U.S. Now, the Fed will also raise rates 4 times in 2022 and start its balance sheet runoff process earlier. That's the latest call from Goldman Sachs. It follows a hawkish pivot from the Fed in its December minutes. Well, to dive deeper into all of this, let's bring Bloomberg's opinion columnist, Marcus Ashworth. Marcus, Happy New Year. It's great to actually have you talk about the markets. I feel like I haven't seen you for a long time. We used to talk Treasuries day in, day out. At what point do they touch 2% and also spark a larger, broader sell-off in the markets?
Well, I think this Goldman Sachs call is fascinating because, you know, if you reread, and I read it several times, the Fed minutes, it's amazingly hawkish. And there's been such a shift from the Fed in a very short pace of time. I mean, ever since the renomination of Fed Chair Powell, that they've done a complete 180. And I think I'm hoping that they're giving themselves this wiggle room on sounding super hawkish to be able to be, you know, less hawkish and more dovish and perhaps only hike rates 3 times, you know, which we'll count ourselves lucky if it's only 3 times. You know, clearly with some of the doves like Kashkari and Daly, you know, 2 is absolutely certain. And I think the confusing thing is whether they tighten.
Yeah, could this be a trick actually? And you know, if you're extremely hawkish and then don't hike by as much as the market expects it, then you know the trick done. You're seen as dovish even though you've hiked.
That's my theory, but I mean, of all the forecasters on U.S. rates in particular, I think Goldman's have the best record, and therefore I'm really sort of interested in this and their logic of how quickly and how aggressively that the Fed want to take back stimulus. I want to reduce the balance sheet at the same time. They're still technically adding bonds at the moment, yet they're talking about how quickly they're going to take them away. It's all a bit odd. I personally think that there will always be something which will happen to the economy, which will slow the Fed down, and I presume that's what will have to happen.
Marcus, thank you so much. A Bloomberg opinion columnist there, Marcus Ashworth. Now, coming up, more Bloomberg Surveillance Early Edition in the next hour with Matt Miller in New York. Kailey Leinz in New York as well, and Anna Edwards here in London. They'll have full market reaction, also looking at the geopolitics of things with Ukraine talks ongoing. This is Bloomberg.
I think the Fed is trying to inject risk in the market that they will respond.
We still have a lot of information to come from the Fed about the balance sheet normalization policy.
It's going to be a lot of inflation pressure over the next few months.
The bond market seems to be pricing in a very hawkish Fed, but the equity market does not seem to be doing that.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Monday, January 10th. Our top stories today. Forecast for the Fed. Goldman Sachs sees 4 interest rate hikes this year, and the balance sheet runoff is likely to start in July, if not sooner. The bond market responds. Investors prepare for that first Fed rate hike of the pandemic era. Yields are soaring globally in line with Treasuries. And turning up the heat on Russia. The US and its allies could block technology exports if Vladimir Putin tries to seize more of Ukraine.
Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz, both reunited in New York. Kailey, good morning. Let's reflect on what we're seeing on Treasury markets and the extent to which those yields are going higher, a continuation of last week's theme, giving equity markets reason to pause, perhaps.
Yeah, absolutely, Anna. The focus really is on the bond market, and that's not just true when it comes to treasuries here in the U.S. That really is a global story, and we saw it playing out in Asia as well. As for the equity story in Asia, of course, Japan was closed for a holiday today, but broadly it actually was an update. The MSCI Asia Pacific Index up about 0.4%. One area of outperformance I would note, even in the face of those higher yields, was China tech stocks. The Hang Seng Tech Index up more than 2 percentage points, continuing a 3-day rebound. So it's a better story for some of those Chinese tech players at this point than some here in the States, for example. Then one individual story I did want to note was Mao Group had a record day, up 19% on reports that China Vanke is in talks with the company for potential asset sales. So that is actually boosting sentiment around that property developer. And then, of course, as I mentioned, the bond market sell-off was evident in the Asia Pacific. I wanted to point to Australian yields specifically, up more than 6 basis points today, sitting at 1.919%. Now, here in the U.S., we have seen some fluctuations in futures trading. We rolled over about an hour ago, but we are just fractionally lower now on NASDAQ 100 futures, essentially unchanged, down about 3.5 points. Of course, that is as we continue to see yields moving higher. We already were coming off of the worst week for the NASDAQ 100, going all the way back to February of last year, and that was as we've seen yields moving up. They are doing so once again this morning, up the better part of 3 basis points. 179 is where we sit on the 10-year. That is the highest in almost 2 years since January of 2022. You're seeing oil resuming some of its gains. WTI dancing around that $79 a barrel level. That is about the highest since November. And then I wanted to point to Bitcoin as well, Matt. We continue to watch it once again below that $42,000 level. Matt Miller, over to you here in New York.
Yeah, really interesting to watch Bitcoin move with risk assets and really not react to the quantitative tightening that we're expecting, to rate hikes that we're expecting, etc. Take a look at what's going on here over in Europe. Of course, I am back in New York physically now, and I'm planning to stay. We have a mixed market there, but there's some red on the screen in the DAX in Germany, at the CAC in Paris. The FTSE MIB's doing a little better. You can see Italy lighting up green there, and the UK and Spain are really little changed. But if you look at the S&P 500, we're about 10 points below the record high that we hit last week. Right now trading at 485, and we had hit 494 and change. The euro dollar not doing much. In fact, at 113, the euro hasn't moved since really the beginning of November, almost October. It's been stuck in this range here. The pound, on the other hand, has climbed up a little bit to about 136 over the past couple of weeks from 132. So there has been some movement there if you look at it longer term. The real action, though, is here, just like in the U.S., in fixed income, in rates, in the bunds, right now almost back at zero, at negative 3.5 basis points. So this is where you're seeing the most movement, because remember, a couple weeks ago we were at negative 30 basis points, and now we're almost back at zero, Anna. So it's interesting to see rates around the world rise.
Yeah, absolutely. And if we do go back through that zero mark on the German Bund, we haven't been there since the spring of 2019. That has a pre-pandemic feel to it, doesn't it? Let's talk then, Matt, about some other things that are on our radar for this week. Fourth quarter earnings season kicks off amid ongoing concerns about the Omicron variant. The Senate Banking Committee is expected to hold confirmation hearings for Jerome Powell as Federal Reserve Chair and Lael Brainard as his Vice Chair. Talks on Ukraine's crisis take place all week. There will be a Russia-NATO Council meeting in Brussels and negotiations in Vienna within the OSCE frameworks. That's the more European perspective. We'll get US CPI data on Wednesday. Consumer prices for November rose at their fastest annual pace since 1982. Could we go as high as 7%? And on Friday, we'll get some US bank earnings from JP Morgan, Citi and Wells Fargo. So there'll be a lot to say about the rising yield environment. The ongoing return to office conversation, though, no doubt also topical for the banking sector. So the Biden administration is looking at possible export controls on Russia if it seizes more of Ukraine. Sources say the White House and its allies are discussing potential restrictions on sensitive technology and electronics. U.S. Secretary of State Antony Blinken told CNN's State of the Union on Sunday that he doesn't expect any breakthroughs in the coming week.
don't think we're going to see any breakthroughs in the coming week. We're going to be able to put things on the table. The Russians will do the same, both directly with us at NATO, at the OSCE, and we'll see if there are grounds for moving forward.
Blinken keeping expectations realistic, perhaps. And let's get more with Bloomberg's Maria Tadeo, who's in Brussels. Maria, good morning. It's a decisive week then for security. Lots of meetings around Ukraine and broader issues taking place. What are we expecting?
Yes, Anna, and today we have this meeting that is happening in Geneva. It's been going on for about, for more than 2 hours now between U.S. officials and Russian officials. Of course, it should set the agenda before that Wednesday meeting, which is really seen as a crucial make-or-break moment this week between NATO and Russia. Now, both sides, as you said, they've really played down the expectations for a breakthrough this week. What we're hearing right now, it's pretty much the same lines that we've heard for weeks now, that if Russia were to invade Ukraine, and let's remember there's 100,000 troops stationed in the Ukrainian border, that consequences and sanctions would be immediate and they would be massive. Russia going into this meeting that is happening, and it's still ongoing, as I said, they say that they're not going into these talks to make concessions, that they have very clear red lines. But I guess, really the focus point will be on Wednesday with that NATO summit.
Let's talk about the EU's role specifically here, Maria, because they have reiterated that it needs to be part of the outcome concerning Ukraine, but also is weighing the potential economic costs of sanctions. How does Europe reconcile the two?
Well, Kailey, the fact to me that the European Union has to put out a blog post on a Sunday night to reiterate that we're here, we exist. This is not just a bilateral issue between Russia and the United States, anything that concerns Ukraine, but also European security has to involve the European Union. It does show that they really have lost momentum in this discussion, that they're very much on the back foot, and they're now trying to get back at the negotiating table. So this is really a role that perhaps is not as significant as they wanted. A lot of this, many would tell you that it's the European Union's own fault. The fact that perhaps they haven't been as aggressive as they should have been in the past on Russia. A lot of this, of course, has to do with the political calculus, but also the energy aspect of this. We know that this is the winter. This is a time of the year where the European Union is the most vulnerable to Vladimir Putin playing politics with gas. And of course, a lot of that playing, especially in the core of the winter.
Yeah, the energy crunch makes all of this a little bit more complicated. Thank you so much to Bloomberg's Maria Tadeo in Brussels. Now let's head over to Washington. House Speaker Nancy Pelosi says there's an opportunity to add federal coronavirus relief aid to a package of legislation funding the government as a February deadline looms. She spoke on CBS's Face the Nation yesterday.
Now, the administration has not made a formal request for more funding, but it is clear from the opportunity that is there and again, the challenge that is there from the resilience of this virus.
Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from D.C. So this is all just potential funding, Anne-Marie, but what could we be looking at in terms of size and scale?
Well, we heard from Speaker Pelosi over the weekend after on the heels of a Washington Post report last week that's thought about initial talks, nothing really concrete, but potentially initial talks about COVID relief funding, given this wave of Omicron that's really hit a number of cities incredibly hard. But Kailey, this would be focused, according to the Washington Post reporting, on businesses. And although the Republicans voted unanimously against the last COVID relief bill of last year, this, at the moment, the talks are really on a bipartisan basis. So you do have some Democrats and some Republicans talking about what kind of relief could we have for businesses, restaurants, hospitality groups, sporting venues, even the minor league baseball teams that are really suffering given this latest wave of COVID. And what could happen is that when we have the funding for the government that's starting to roll down on February 18th, they must come up with another bill. Speaker Pelosi is saying at some point in this funding, potentially, if they were to go ahead with some COVID relief, it could be linked to that.
Speaking of relief, some in the Democratic Party, certainly not all, have been concerned about middle-class families in the tri-state area getting hit so hard by state and local taxes without any deduction or the cap on the deduction. Are we going to see any SALT relief here?
This is a big concern, especially as this is an election year and as these congressional lawmakers go back to their districts. Many of them promised or were elected after the SALT cap came in effect. We have seen a number of Republican grounds like Orange County swing to Democratic because they campaigned on SALT. And at the moment, Matt, SALT is tied up in the Build Back Better legislation. That is parked at the moment. And with that, SALT is on hold. But there's a number of key districts, at least 24, that Democrats are looking at to see what they can do, because these were individuals who really won on making sure that they could bring back and get rid of the SALT limit.
Amory, thank you very much. Bloomberg's Amory Horden there in Washington. Now, back to the bond market story, and bond yields are soaring globally in line with Treasuries as the investors prepare for the first Fed rate hike of the pandemic era. Bloomberg's Danny Berger joins us now with more. This isn't just a U.S. story, but we've certainly had, it's a global story, but it's being driven by the U.S., Danny, and the Goldman Sachs call catching everybody's eye.
Yeah, 4 rate hikes from Goldman Sachs. This really encapsulates the turn that not just strategists, but markets are taking and facing this morning. This call from Jan Hatzius, it really is off the back of that stronger labor data coming in on Friday. Unemployment below 4%, wage rises as well. So in order to combat an economy, prevent it from overheating, Goldman says that, yes, 4 rate hikes in 2022, but this call also has a balance sheet runoff starting in July, because this large balance sheet means that we see it weigh on longer term debt. That yield flattening of the curve is something that the Fed has certainly been concerned about. But also important to make clear that even though Goldman is upping its forecast to 4, in some ways, this is already consensus in the market. I have a chart for our radio listeners that compares the forecast as surveyed by Bloomberg and what the market is forecasting. So the survey of economists sees 3 rate hikes. However, market almost up at 1% by the end of the year. So in some ways, Goldman really just playing catch up with the market at this moment.
So we've seen some real moves in rates, and not just on this side of the Atlantic, on that side as well. In fact, global rates are rising at a pace that is not casual, as Kailey puts it. What do you make of the moves in rates?
Yeah, certainly not casual. Well, I think Bank of America put it really well that perhaps one of the risks that markets are now grappling with isn't just a Fed that's going to hike rates, but also tightening from the ECB and the BOJ. What does that mean? Well, so far for markets, it means that the superlatives are coming in hot and fast. You mentioned globally, bonds closest to 0 since May of 2019. We're looking at a 2-year yield that's its highest since March 2020. 10-year yield, its highest since January 2020. This is a bond market that's now priced the same as we were before the pandemic. So in other words, we're about to see liquidity zapped from markets. Bank of America also calls this the end to the liquidity supernova. And that in itself, not just for the bond market, but will also be challenging for equity flows.
Absolutely. Thank you so much to Bloomberg's Danny Berger. And let's get back to the equity markets now. There's some stocks moving in pre-market trading in a not so casual way either. One that is actually moving to the upside is Shockwave Medical. This is after Bloomberg reported that it is potentially in talks to tie up with Penumbra, which is a medical devices company. Even though Penumbra says those talks aren't happening, investors are still putting up those shares to the tune of about 6.5%. And remember, this is a stock that is up like 900% since it IPO'd in 2019. To the downside, though, we do have a number of stocks lower on the back of analyst recommendations, one being Hilton Hotels, which was cut to market perform over at Bernstein. The analyst putting a $161 price target on the stock. It's trading at $149 this morning in pre-market trading, down about 2 percentage points. And then you also had a downgrade from Morgan Stanley when it comes to Cognizant Technology, which is an IT services and software company. It is now down about 12% before the bell, Anna.
Yeah, interesting. It's the travel and leisure stocks actually doing the best here in Europe in the context of what you're saying there about Hilton. Coming up then, Kailey and Matt on this programme will weigh the recovery and the risks with Derek Halpenny of MUFG. And veteran investor Mark Mobius says to watch out for much higher yields. More from that interview. That's still ahead. Plus more on the high-stakes US-Russia talks with Elisabeth Braw, American Enterprise Institute resident fellow. She gives us her perspective. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York with Kailey Leinz and Anna Edwards in London. I want to welcome also our listeners on Bloomberg Radio. We are simulcast on both Bloomberg Radio and Bloomberg Television in this hour. And we've been talking a lot about rates because of the incredible rise that we've seen over the past week. The 10-year yield is up to almost 180, which is the highest that we've seen it. What did you say, Kailey, since the spring or?
January 2020.
January 2020. So yeah, feels very pre-pandemic. At the same time, the S&P dividend yield has hovered the last year or so around 129. So Treasuries are yielding out a lot more than stocks, and that's really interesting, that relationship, to see how it's going to work out. Let's talk to Eddie Vanderwalt from our MLive team. He joins us right now out of London. Eddie, how do you expect this run-up in rates to affect stocks, which had such an incredible pandemic, really?
You know, we're going to see this reverberate across markets. I think, yes, absolutely. In the stock market, we're going to see this because your long duration stocks, your tech, your property firms and so on, I think they are really going to feel this. But I actually think that we see, you know, we finally, yes, we've had talk of Europe outperforming and of value outperforming for a very long time. But I think this could be the moment. And I think, you know, rather than a sell everything opportunity, I think this is also the moment for active management. Now, I know I've just hit a lot of wish lists. A lot of people have been wanting this for a long time. But I think this could be the moment. This bond yields seem to be saying that.
Well, here's the take from JP Morgan and the team over there, Eddie. They put out in a note overnight, as long as yields are rising for the right reasons, including better growth, we believe that equities should be able to tolerate the move. The rise in real rates should not be hurting equity markets or economic activity, at least until they move into positive territory. Eddie, even with the move we've seen so far year to date, we're still negative 77 basis points on the 10-year real yield. Do you actually see a scenario in which we reach positive territory in the medium term?
That's a hard call to make. I think you know, that's going to depend so much more for me on inflation expectations and how aggressive the Fed is. I hear Goldman, and I see that call from them that says equities can do well, but it depends on which equities, right? I think some of those tech companies are extremely highly valued and may see a pullback, but then that might be good for the market overall because some of the the companies that have lagged so far may start catching up. Some of your value firms. I also think, that it's interesting to see that in terms of real rates, the bottom that we've now seen, I think around about November time, that was significantly flagged earlier in the gold market. Gold pulled back quite a while earlier, and people whose memories go back to 2013 will remember that gold also flagged the bottom in real yields back then.
Okay, yeah, important to get that quote that Kailey brought to us there from JP Morgan into the conversation. Thinking about inflation expectations and where they go then, Eddie, are we in danger of things worsening once again or inflation spiking once again? When we look at what's going on in China and what is now a fight against the Omicron variant and how destabilizing that could be to the global economy.
Yeah, and many people worry about the implications of inflation because, we had supply chain disruption last time around. Maybe we have supply chain disruption this time around as well. I think the indicators that we're seeing in the market, we're seeing a lot of the pressures coming off of supply chains. Things like the Baltic Dry, they aren't as high as they were back in October. And natural gas prices in Europe, for instance, they very high. But at some point, you see them pulling back, or at least not rising at the same rate. And I think, therefore, it is significant. I think that feeds through, and I think that makes that makes for a softer inflation environment.
Okay.
So I think that will be interesting going into the rest of the year.
Okay, so something to counter that inflation worry perhaps coming through from China. Eddie, thank you very much. Eddie Vanderwalt from our Markets Live team. Remember, you can get market analysis from the whole Markets Live team. MLIV Go is the function to use on your terminal. This is Bloomberg.
This is is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's get the first word news. And in Kazakhstan, security forces backed by Russian-led troops are restoring control after crushing demonstrations. The government says almost 6,000 people have been detained. According to state TV, 164 people were killed. The real number is thought to be higher. Omicron has flared in a port city that borders Beijing and spread inland before Chinese officials detected it. That brings the contagious variant to the doorstep of the capital less than a month before the Winter Olympics begin. Officials in the city of Tianjin have told its 14 million residents not to leave town unless it's essential. And tennis star Novak Djokovic may be able to stay in Australia and go for a record 21st Grand Slam victory. A judge has quashed the cancellation of his visa and ordered him released from a detention in a hotel. Coming up, we'll get away from the tennis saga and back to the markets with Derek Halpenny of MUFG. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Matt, it is great to see you back in New York now, reunited, as I said, with Kailey. I'm stuck here in Europe still, willingly, I should add, and I just wanted to flag where we're seeing the market moves today because it paints a really interesting picture of what the market is and is not concerned about here in Europe right now. This doesn't seem, in the very here and now, to be a market that's worried about Omicron. Travel and leisure is the best performing sector here right now, but it is a sector that is increasingly pricing in a tighter rate environment. Banks go higher, real estate and technology stocks falling.
Yeah, well, and you're not really in Europe, right? You're in the UK, which
let's not start that one again.
Legally broken off and also is separated by a channel of water. And I mean, the great thing is, now that I'm back here in New York, we're broadcasting live from the twin financial capitals of the Western world. So it's great to have you out of London and be here with Kailey in New York. Now, in terms of Omicron and how that's affecting European trade as opposed to how it's affecting the U.S. trade, we've seen these things hit in different waves, and now it seems to just be a big push across the entire globe in terms of a rise in the number of cases. The question is, what does that, how hard does that hit the economies, right? And what we're seeing here, certainly in New York, is a lot more people are calling in sick. In fact, I think an economist recently said 5 million people in the U.S. called in sick last week. So that's where you're starting to see the real economic consequences.
And that is a theme that unites these two financial capitals, because we're certainly seeing that here in London as well. We're seeing that across the UK. And there have been plenty of calls to reduce the quarantine period here in the UK as a result. Kailey, what are you seeing then ahead of the US start of the trading day?
Well, it seems to me that the market is focused much less on the Omicron variant and more so on Federal Reserve policy. When will that liftoff actually happen? And you are seeing that reaction in the bond market, which is reading through to the equity market. NASDAQ 100 futures are really fluctuating in the futures trade. Right now, they are essentially flat, down at just about 7 points. But of course, we're coming off the worst week for the index going back to February of last year. That's as we continually see yields moving higher. We actually haven't gotten a day in 2022 when the 10-year Treasury yield has gone down. It is going up once again this morning. It is off session highs, though. We're up just a little bit above a basis point, sitting at 177. But that is around the highest since January of 2020, pre-pandemic, is realistically what we're talking about. And then, of course, it's not just the nominal yields we're watching, but real yields moving higher as well. Once again, that is true this morning. We're sitting around negative 77 basis points. And then just pointing to crude, oil was trying to gain some traction once again after losses on Friday, but right now it is fractionally lower. WTI trading at 78.83 a barrel. Now, as for some movers in pre-market trading, Anna, you were talking about how banks were doing well in the European trade. That is true when it comes to what's going on before the bell here in the U.S. as well. The financial select sector SPDR ETF is higher by about 0.5% or so in pre-market trading, and you're seeing the likes of Bank of America, Wells Fargo, each up in the ballpark of 1%. Citigroup also moving higher by about 0.9, Matt.
All right, I'm taking a look at what's going on in terms of forecasts for rate rises. And of course, we know the dot plot has shown us that the Fed expects 3 rate rises now this year. That was kind of the surprise that we got out of the last meeting. The market continues to expect more and more, maybe even 4. In fact, we were talking earlier about Jan Hatzius at Goldman Sachs. He expects maybe 4 rate increases this year because he says a rundown in the balance sheet, quantitative tightening, so to speak, no longer counts as one for them. Joining us now is Derek Halpenny, MUFG head of research, global markets, EMEA, and international International Securities. So, Derek, you're running a lot of stuff. But in the meantime, let me ask what your take is on the Fed. Are you expecting the same as what the dot plots are showing us? Is the market getting a little ahead of itself with an expectation for 4 rate hikes this year?
I think it could be. You know, we're not in the camp of 4 rate hikes. If you consider what the market is now anticipating, a quick end to quantitative easing, 4 rate increases, and then quantitative tightening commencing at some time later in the year. And that all in the space of 12 months is a considerable change to the monetary stance. And I think the idea that we get through the entire year without some kind of major disruption to risk, I think is quite unrealistic. So I don't dismiss where the market's moving at the moment. You cannot ignore the Fed and the real shift in hawkishness that was revealed in the FOMC minutes. So pricing this way is pretty obvious based on the fact that the Fed now acknowledge that maximum employment is in place, and therefore the focus now is very much on inflation risks.
Okay, so with those inflation risks in mind, good morning to you, Derek. We then focus on when do we see action from the Fed, and could it come as soon as March in terms of the first rate hike in the pandemic era? Derek, we're just hearing from Thomas Barkin, of course, of the Richmond Fed. He's saying that it is conceivable. Richmond Fed's Barkin says a March rate rise is conceivable, according to Dow Jones. When do you think we're going to see the first rate rise in the US?
Well, the MUFG official forecast is June, but certainly if you consider the inflation figures over the next couple of months just on base effects alone, but then you add in on top of that the Omicron risks, and I know the markets are looking beyond Omicron, but it still has a very high prospect of impacting to some degree inflation over the short term. And I think those mixed together, there is a reasonable chance that they could go more quickly. Where I would question is going forward, perhaps up to the middle of the year, where rates get to at that point in time to actually deliver in the second half of the year, I think will be a lot more difficult to do. You know, I think what we really need to look at, there's a lot of focus at the short end in terms of what happens to rates this year. But if you look at the terminal Fed funds rate implied by the markets, it's still less than 2%. The Fed are telling us it's 2.5%. And why we're bullish on the US dollar over the short term is we think at some point shortly, over the coming months, the markets are going to reassess what they believe the terminal Fed funds rate is, and they're going to have to start pushing that a bit higher, closer to what the Fed believes it is. And I think that then moves the forward OIS markets 2-year, 3-year. And I think that shift in rates in 2 to 3 years' time is the catalyst for renewed dollar strength.
And what does that mean for yields, Derek? How much higher can they go?
Well, I think by the middle of the year, certainly 2%, north of 2%, 2.1%, that I think is very feasible. If you assume there's at least a 20 to 30 basis point shift in expectations about what the terminal Fed funds rate is, that to me, I think is quite feasible. Of course, there are uncertainties, in particular on Omicron. You know, there's data beginning to emerge that it's not just supply side issues, but also demand side issues. So there was data from Australia, for example, showing that spending in Sydney not only dropped, but dropped to its worst point since the whole pandemic began. So there is in certain countries an impact that's going to come through on the demand side, as well as obviously the supply side that we were talking about before, or you guys were talking about. So, you know, I think, there is that uncertainty, but certainly at this point, a rate hike in March is very feasible.
Okay, and where does that leave stocks then, Derek? If you're talking about 2.1% or so mid-2022 for rates, I mean, JP Morgan saying stocks can live happily alongside rising yields, as Kailey was telling us earlier on, if those rising yields are being driven for the right reasons. Do you see that as being the case? Is inflation one of those right reasons, and where does that leave stocks?
Yeah, again, you know, I think the fallout in risk is obviously greatly more diminished if there is compelling growth factors behind the shift from the Fed. Our own view, though, is in the second half of the year in particular, the supply constraint issues, inflation, energy prices, we're going to see all of those factors subside as the kind of prevalent risk that they are at the moment. And that in itself will allow the Fed around mid-year to maybe rein back some of those expectations and go a little bit more slowly. Obviously, in those circumstances, that would be reasonably positive for equity markets. But I think we're in more challenging times before we get to that point.
Yeah, absolutely. It's almost utopian. Reduced supply chain issues, inflation falling back, and energy prices falling back. Derek, thank you so much for joining us. Derek Halpenny, MUFG. Coming up on the program, Elisabeth Braw, American Enterprise Institute resident fellow, weighing in on tensions, of course, between the US and Russia. Where does that leave Europe? Lots of conversations taking place in Europe this week around the relationship between Ukraine and Russia. We'll talk about that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Pfizer Chairman and CEO Dr. Albert Bourla. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. While crucial talks between the U.S. and Russia take place this week, the Biden administration is looking at possible export controls on Russia if it seizes more of Ukraine. Joining us now is Elisabeth Braw, American Enterprise Institute resident fellow. Elisabeth, Secretary of State Tony Blinken has really tried to play down expectations for the talks this week. Do you think we could get anything tangible out of them?
I don't think we'll see any agreements between the US and Russia, which is the talk that will happen first. And it's unlikely we'll see anything substantial in the subsequent talk. So that's between Russia and NATO, respectively, and then within the OSCE, which also involves Russia and Ukraine. But I think the most substantial effect or outcome is easy to predict, which is that Russia will emerge victorious because the US has agreed to meet on a one-on-one basis with Russia, and that's leaving European countries annoyed. Yes, they'll be meeting, joining the two subsequent meetings, but they are annoyed that this meeting between the Russians and the Americans is taking place without them, and concerned about what sort of concessions the US might make, even though it has said it will make none.
Right. Well, I mean, the U.S. has been annoyed for so long about Nord Stream 2, but that didn't stop the Germans. Does Vladimir Putin ultimately win out in the end in terms of enlarging the Russian footprint geographically? I mean, is there anything the U.S. and Europe could actually do if he went in to take out the rest of Ukraine?
Not unless, but if they want to stay out of a major war, short of that, short of a major war, there's very little they can do. Now, what they can do, and which has been discussed, is some sort of an exclusion of Russia from the SWIFT system and more sanctions, of course. But sanctions are sort of a sorry old instrument. Everybody knows that if you do something bad internationally, some of your officials, some of your industries might be sanctioned. The SWIFT system might be more effective, excluding Russia from the SWIFT system. But these are relatively limited measures still. And so if you're going to carry a big stick, then you have to be serious about getting into a war with Russia. And there's absolutely no appetite, I think, in Washington or anywhere else in NATO for a war against Russia over Ukraine. It's sad to say, but I don't see how that could possibly be put together, even within a sort of an ad hoc coalition.
And what are the drawbacks then of ceding that territory to Putin, aside from the obvious human rights problems there? In terms of strategy, does that give him some kind of leg up?
Well, so Putin's foremost priority seems to be Ukraine. Many Russians, including him, have a sort of an emotional attachment to Ukraine, which they see as part of Greater Russia, in a way that, for example, the Baltic states and Sweden and Finland are not seen as an historical part of Greater Russia that's sort of the emotional background against which we have to see this. But even against that background, it would be very costly in blood and treasure for Putin to invade Ukraine in anything more than what we're seeing in eastern Ukraine, which has been going on for a number of years now. So I think what he'll do is he'll just keep his troops at the Ukrainian border, keep spooking Ukraine, and threaten violence every so often, and that will spook investors, and that will harm Ukraine in a quite serious way, and leaving the Ukrainians unable to do anything about it because the Russians are allowed to have troops on their side of the border, and the Ukrainian economy is already weak, so it's sort of a lose-lose situation for Ukraine there.
So he carries on with that strategy. Elisabeth, what is the purpose of the Russians, of Vladimir Putin, asking NATO to roll back its geography to pre-1997 levels? Does it think that would remotely be agreed to? And if not, what is the purpose of asking for that?
It's to, first of all, raise very high stakes for NATO. So now we're all talking about this, and it's something that really wasn't up for discussion even a few years ago. It was seen as quite natural that countries are able to choose which sort of organizations they want to belong with, how they want to conduct their foreign policy. Now Russia, by submitting this draft agreement to the United States in December, has all of a sudden made that made the accession of former Warsaw Pact member states, and especially former Soviet republics, has made the Russians have made that a point of very intense discussion all over Europe and beyond. So something that that seemed accepted and acceptable until very recently is now something where they can make demands. And so the problem then for NATO and the Americans in particular is to be able, are they able to say, well, hang on, that goes too far, or will they make some sort of concessions? And then some of the European allies will say, no, that's why are we making any concessions at all? So raising the stakes right at the beginning is a clever strategy.
Elisabeth, thank you so much. Thanks for joining us. Elisabeth Braw, American Enterprise Institute Resident Fellow. Thanks for joining us to discuss that important geopolitics. Coming up in the next hour, Editor of Foreign Affairs, Dan Kurtz-Felon, will be joining the team. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Veteran investor Mark Mobius says the recent spike in U.S. Treasury yields has room to run as market participants are underpricing inflation risks. Mobius spoke with Bloomberg's Yusuf Kamel Eldin earlier.
As I pointed out many times before, the CPI is a very inaccurate measure of what is really happening in the economy. If you consider the fact that the money supply in America went up by over 30% last year, you have to expect prices to go up by that much. The good news, of course, is that technology pushes prices down, but the reality is that, in fact, those 7% numbers are probably underestimating what is coming down the pike. So we can expect higher prices, but of course, higher wages, because you can see unemployment is down, and people will be getting more money. So you're going to see a balancing of these two forces as we go forward.
I'm looking at what's happening with U.S. Treasuries, and we picked up where we left off on Friday with higher yields. The 10-year futures now at the lowest level since December of 2019, bonds under pressure in Asia. I'm wondering, how high can rates go? I look at 30-year, kind of busted through the 2% mark as well.
I think they can go much, much higher. They've got to equal what we're seeing with inflation at the end of the day, because people are not going to be buying treasuries if they see that they're only getting 2 or 3%, but inflation is 7, 8, 9, 10%. So at the end of the day, those rates have to go up.
Okay. Well, with higher rates, the traditional thinking would be that, tech would underperform, which is why we've seen quite a bit of volatility in the Nasdaq, for example, over the last few trading sessions. And then, have that broader rotation. Are you subscribing to that broader rotation?
Well, I think what's happening is that those tech companies that have not been making money, they're going to be in deep trouble. Those stocks are going to go down in price. But companies that are having a very good return on capital, paying dividends, have a good profit increase, those companies are going to be outstanding. They're going to be outperforming. So there's going to be a strong differentiation in the market, if you will.
In terms of the geographic differentiation, when you talk about some of the opportunities in the market, Europe vis-a-vis the United States, what is the split in an allocation?
Well, United States, of course, is the winner at the end of the day because they are, it's the economy where most of the large companies, global companies are located. And a very important point to make about the American market, and that is many of the American companies are actually emerging market companies because a large part, if not a majority of their earnings and their production is taking place in China, in India, in Vietnam, or all these emerging countries. So no question, the allocation in America should be higher, certainly higher than Europe.
That was veteran investor Mark Mobius speaking with Bloomberg earlier. And now a look at what else we're watching. I'm actually watching what Mark Mobius is watching, and that is Treasury yields. We have yet to see a day, guys, in 2022 where we've seen the 10-year Treasury yield moving lower. Once again, it is actually higher today. We're up about 26 basis points year to date, and that's only 6 trading days. A really, really remarkable move in a very short amount of time. As I said earlier, Matt, it's not casual, though I would note some of that selling pressure does seem to be easing. We're off session highs when it comes to yields at the moment, and you're actually starting to see yields moving lower in Europe with the Bund yield now a little bit more negative than it was.
I can't help myself but to mention that on the chart where the line goes higher and higher and the numbers actually say plus 26, it's in red.
Because people are selling treasuries, Matt.
Yes, I realize, but we're showing the yield, and the yield is rising. Rising things are green. I'm watching CZ. His wealth has risen for sure. Bloomberg Billionaires Index has now done an estimate as to how much money he's worth, and they say $96 billion. All right, there's a change in the price of a lot of crypto coins today. So now $95 billion. This puts him at almost, more than twice the wealth of Satoshi. If a Satoshi Nakamoto exists, he would be about 2 years older than CZ. We would think he's 46 years old. CZ is only 44, but have half as much money because Satoshi could have about 1.1 million Bitcoin at this valuation.
I like how the name has to have an asterisk after it because there are a few things we don't know there. I'm watching the Omicron outbreak, of course, over in China, an ongoing one. The port city of Tianjin, not all that far from Beijing, now very much the focus of things. Isolated outbreaks starting to blend into each other just a month before the Olympics. Certainly something that we'll watch from an inflation perspective globally as well. This is Bloomberg.